A monetary standard is not the same thing as bullion purity. A silver standard and a gold standard are monetary systems, not grades of bullion. Under a metallic standard, a government defines its currency in terms of a fixed quantity of a metal and permits conversion under the rules of that system. A gold standard uses gold as that anchor. A bimetallic system recognizes both metals at a legal exchange ratio. In a full convertibility system, holders can exchange eligible currency for the defined quantity of metal. That promise constrains how much currency can be issued because the issuer must maintain reserves and confidence in redemption. The metal is therefore the monetary anchor. It does not mean every transaction uses coins. Banknotes and deposits can circulate while the legal conversion promise sits underneath them. The system can promote long-run exchange rate discipline, but it also limits a central bank's freedom to respond to recessions, banking panics, or a sudden demand for cash. The United Kingdom suspended gold convertibility during World War I, returned in 1925, and suspended it again in 1931. Those shifts show that a metallic standard is a policy framework, not a permanent law of nature. A country on silver could experience exchange rate movement against countries on gold when the market price between the metals changed. Large changes in mine supply, industrial demand, or international preference could alter the relative value of the monetary base. Both systems tie currency to a redeemable metal, but they create different operating conditions. The central difference is which commodity anchors redemption and how that metal's supply and international market affect the currency. Mint notes that this ratio differed from the world market. That mismatch is central to understanding silver as money throughout history. When a legal ratio and the market ratio disagree, people naturally spend the legally overvalued metal and hold, export, or melt the undervalued one. Imagine the law values 15 ounces of silver the same as 1 ounce of gold, while traders abroad will give more than 15 ounces of silver for that gold. Gold coins become worth more as metal than as domestic money. If the market moves the other direction, silver becomes the metal that disappears. This is why a bimetallic standard can behave like a single metal standard in practice. The Coinage Act of 1873 moved federal policy away from bimetallism and toward gold. Critics later called it the crime of 1873 because the political consequences were not obvious at passage. Debates over restoring silver remained central to American politics for years, especially for debtors and agricultural communities that wanted a larger money supply. Supporters value the constraint a metal reserve can impose. Authorities may respond with higher interest rates or tighter credit even when the domestic economy is already weak. The standard can defend convertibility while making employment and lending conditions worse. Modern bullion ownership is separate from adopting a silver standard. When you buy a 1 ounce silver coin or bar, you own a physical asset priced in dollars. The dollar is not redeemable for a fixed amount of that silver. Also